Hello, everyone. I'm assuming that you can see me and hear me fine. I know the introduction was just made. So I will.
Okay. Can you hear us?
Yes, I can hear you fine.
Now we can hear you.
Okay, great. So should I proceed and start?
Yes, we are ready now.
Okay, so good morning, everyone. So thank you for having me. And certainly, we are trying to work through the Zoom technology and such. I wish I was there in person. I know you are in a great location out in the Gulf Coast. But thank you for having me at a time when housing market is clearly going through some transition. We have had an extraordinary couple of years in 2020, 2021. I know it was difficult in terms of lifestyle with COVID disrupting our life, but the housing market really took off. But now in 2022, things are different. Mortgage rates are much higher. Sales are coming down. We had a fresh data released this morning on the national home sales, which fell for 6 straight months. We have to go back all the way to about 2015 in terms of the current sales activity. So even coming down below pre-COVID. This is not to say that homeowners are not happy. Homeowners are smiling big. They have seen huge price gains. There's no concern for homeowners. The question is about home buyers. Home buyers are facing difficulty, and also some home sellers. Maybe they want to change the different neighborhood. Maybe they want to trade up. Maybe they're considering school district, all that part. But now they're saying, I have 3% mortgage rate. I don't want to give it up. So the new listings are not really popping out because of that lock-in effect. Let me put the PowerPoint slide onto the screen and go from there. So hold 1 second as I put the PowerPoint onto the screen. Okay, so here we are. So trying to give you a market update and outlook. So let's first start with the broader economy because recession is not something that we want to encounter. And there is some discussion about whether or not we are in an economic recession. If we look at this chart, which is the broader economy or something called a GDP, you often hear a politician mention about GDP. And what it shows is that at the beginning of the chart, this is when we had the COVID lockdown. Economy collapsed. We were stuck at home, not able to do anything. Economy collapsed. Then once the economy reopened, Zoom, a lot of economic activity, and then trying to sort of normalize. But the recent 2 quarters in 2022, slight negative. Nothing major, but nonetheless slight negative. And generally, economists would say when there is a 2 consecutive quarters of a decline, it would be considered as economic recession. Now, one of the factors contributing to this strangeness in the economic data is related to the inventory. So this chart shows overall inventory at a retail shop. So generally rises because we have increased population. But during the COVID, it got really disrupted. I mean, people were piling on, even from toilet paper to baby formula, it was not around. So inventory really shrank, but now one can see it's being restocked. So, that's at least bringing in this additional inventory. In some cases, they're saying they are overstocked, so they want to try to have a big sale like at Target, trying to remove some of the inventory. But this also means that some of the supply chain disruption is ending, especially for home builders who need to get their lumber, appliances on time. And now maybe they can begin to have construction completed on time. Just to give you a little flavor on the supply chain disruption, I happened to be at a conference yesterday on commercial real estate, where a keynote speaker was none other than Emmitt Smith, the all-time NFL rushing champion. He is in commercial real estate, so he does doing a lot of construction work, company manager, the owner, along with commercial investment deals. But one thing that he say is a little bothersome is that supply chain. He's not getting all the things on time, which is delaying some of his project. But we think that those delays will be soon coming to an end, as you can see on the chart, that the inventories are beginning to become more available. If we're in an economic recession, it would be one of the strangest economic recession of all time, because you walk through the streets and you see help wanted sign. If you are a large broker, you want to hire an assistant, you know how difficult it is to hire an assistant unless you offer them really higher wages. So it's really difficult to find the right workers, because the blue line represent help wanted sign across America, while the red line shows how many people are looking for job. So we have actually more job openings than people are searching for job. There's always an issue about right job match. Someone who lost a job at a manufacturing is not interested in being a cashier at a 7-Eleven store. So, even though there may be a job opening, does not mean that people will find that job immediately. But nonetheless, we are in a situation where there is more job opening compared to people searching for job. So quite a bizarre recession if we are in a recession. If we look at the job market conditions across the country, we see some variation. When you look at Mississippi, it's 0.5%. So what does that 0.5% mean? I hope people in the back may not be able to see it, so I will just say it's 0.5. That means in Mississippi, there is 0.5% more jobs today compared to pre-COVID, March 2020, pre-COVID. So Mississippi has now more jobs than before. Not the case in Louisiana. Louisiana is down 3.4%. For 3.4% fewer jobs in Louisiana compared to pre-COVID, because they are not doing some drilling activity. Oil drilling is not as active as before, and harming some of the job creation in Louisiana. I put a color code to indicate that some states are positive. Generally, the bluish color states are positive. So you look at Rocky Mountain State and then the southern states. So Texas, Florida, Georgia, Mississippi, all positive. Tennessee, super positive, 3.5% in Tennessee. So only exception is really Louisiana, maybe because of the non-active oil drilling, which is a puzzle. Given high gasoline prices, we should be drilling more. But some people are saying that excessive regulation or companies just being cautious about what Washington may impose on oil companies. So you see a little variation. So red color states are states that are still down in terms of job from pre-COVID days. So Mississippi, at least, is positive. Now, if we look at the overall job market condition in your local area, Gulfport, Biloxi, Pascagoula, I hope I am pronouncing it correctly, so this greater local area. So this is the total number of people with jobs. So what you see is from year 2000. In year 2000, there was around 170,000 local residents receiving W-2 salaries, payroll jobs. I know many of you are independent contractors, so you don't receive W-2, but these are W-2 salary employees. So 170,000 jobs, no meaningful movement until Hurricane Katrina hit. When Katrina hit, there was job losses. Then your local area fully recovered from that. New Orleans, not the case. In New Orleans, they are still down after the Hurricane Katrina, but in your local area, you have fully recovered from Katrina. And then moving sideways until COVID hit. So when the COVID hit, job decline, but now you actually have more jobs today compared to pre-COVID days. Maybe this is part of people wanting to vacation more, or maybe people are saying, look, I can work from home. If I can work from home, those office workers, they're saying, why should I stay in New Orleans or in Dallas or in Birmingham? Maybe I want to go to closer to the water. So looking at the Gulf Coast as possible condition, and of course, then you need the support. Restaurant workers, medical staff need to hire more people, so that could be creating some jobs. So more jobs in your local area now compared to pre-COVID days. But the home sales are trending downwards. So this is pending contracts on a nationwide basis. Many local markets are following similar pattern. I put that red line to indicate the condition right before COVID. So when we had a lockdown, sales collapsed. But once the economy reopened, to quite a surprise, even above pre-pandemic, and stayed above for 2 straight years because of the record low interest rate environment. Then, beginning of this year, sales began to trend down below the red line, below pre-pandemic, because mortgage rate hit 6%. The change in mortgage rate of 3% last year to 6%, it means about 35%, 40% higher monthly payment. And for some people, they simply cannot make those monthly payments, or they do not want to make those monthly payments. So that's why the sales are coming down, because of the higher mortgage rates. But the prices, even as the sales are coming down, prices are still rising, much higher compared to 1 year ago. So in your local area, what you see on the price appreciation is that the first little hump that you see, that was related to the housing market bubble and crash. That was back in 2005, subprime lending, mortgages for anyone. But it was very risky, and we suffered the consequence of a foreclosure crisis and price decline. This time, prices are rising not because of subprime lending. Thank goodness we don't have those risky mortgages anymore. So prices are rising because we don't have enough supply, while the demand was pushed higher from low mortgage rates of the past 2 years. But don't expect price increases to remain this high. I think it will begin to level off. And by end of the year, like December, home prices in your local area could only be maybe 5% higher compared to 1 year before. So price appreciation, I think, will continue, but less strongly given some of the recent sales decline. There's all this talk about housing recession. And what you need to consider about the housing recession is the following. For the builders, it feels like a recession because they're canceling many contracts. For you, maybe it does feel like lower activity, lower business activity, but it is not a housing recession for your past clients. People who bought their home past 2 years, they're smiling. They're saying, oh, I feel good. My wealth is rising. So it is not a housing recession for homeowners. It may be for home builders currently, or people trying to do some home sales, but not for homeowners, which is important in that you may want to contact your past client to say, congratulations, weren't you lucky to buy a home in 2020 or in 2021? Because they locked in those low interest rates, they were the lucky ones, and they're not in any financial distress. In fact, they are building wealth through home price appreciation. If we look at what's going to happen to the mortgage rates, the good news is that all the increase in mortgage rates may have already occurred. 6% mortgage rate in early June, I think that is the peak. Today, mortgage rate rates are about 5.5%. It has actually come down. So the blue line is indicating the 30-year fixed rate mortgage. So it sort of peaked at 6%, but now beginning to come down. The red line is what people in Washington do. This is the Federal Reserve, and they push up the red line or reduce the red line, something called a Fed funds rate. And right now they're raising. They will raise it more in September. But increase in red line does not automatically mean increase in blue line. Look at the middle of the graph. The red line increase, decline, but the blue line barely budge. So we could be in a similar situation as Federal Reserve increase interest rate, the mortgage rate may say, we don't care anymore because we already priced that in. So mortgage rate may not further increase, which is a great relief for those buyers still in the marketplace. And in fact, in the mortgage rate right now, 5.5% is actually a little lower than 6%. So people who got priced out in early June, maybe they want to reconsider because mortgage rate in some weeks are actually going down to 5%. So lock in those rates when it's a little dip, and maybe they have a better chance to pick up the right property. Now, one thing that is bringing the mortgage rate down is the following. So you have the mortgage rate just showing again, which is the blue line. So you went up to the 6%, now beginning to come down a bit. But it's coming down because oil prices are coming down. To show that if oil prices rise, that means we have higher inflation, and higher inflation means the Federal Reserve has to raise interest rates. But if the oil prices decline, then the Federal Reserve does not have to be so aggressive in raising interest rates, so the mortgage rate can come down. So to this extent, if we can drill for more oil in Louisiana, in Alaska, in North Dakota, then we may actually have a lower mortgage rates. Not only that, you will benefit because you are suffering from this high gasoline prices. Realtors drive more than the general population. So low oil prices, low gasoline prices helped you immediately in terms of your business costs, but it helps your clients in terms of lower mortgage rates. So if we can get more supply, it will certainly help in that direction. Here's what other fellow realtors are doing across the country. Half of the homes today are being sold at list price or slightly above because there's still some residual multiple offers, especially on the lower end. They're still drawing some multiple offers. But other half of the homes are not drawing multiple offers and sitting on the market. So I looked at this days on the market and how much price concession the realtors are doing. So this is from the multiple listing service across the country. And what one finds is that in the first week, through price negotiation, there's about 5% price discount from the list. But as the days on the market lengthens, for example, 2 months, it looks like price discount of 8%. Then if it's 120 days or longer, the price concession is almost 11%. So longer the days on the market, naturally larger price discount, what the other realtors are doing in order to find out buyers. So that's why it's so important to price the home correctly on the first round. So you don't have to do large concessions, over time. So this is what the other realtors are currently doing in the marketplace. Something to show constantly as a reminder. Sometimes there's a television program to say home prices are high, maybe you should not buy. Maybe that was the case with subprime lending, those funny, risky mortgages. We don't have those funny, risky mortgages anymore. And what we find is that homeowners build wealth over time. So for a typical homeowner across the country, they have around $320,000 in net worth. Everything you have financially minus everything you owe, how much do you have? This is for a typical homeowner. I am in Washington, D.C. Home prices in Washington is much more expensive than in Mississippi. So maybe there's a larger wealth in, say, Washington, San Francisco, Boston area, and maybe a little lower in the southern states. But nonetheless, this gap is so wide that, say, typical homeowner in Mississippi may have about $200,000 or $250,000, much higher than what the renters had. So to show that over a long period, homeowners build wealth compared to renters. The only thing renters are facing is higher rents. Rents are rising, and then going to face another higher rent next month. While homeowners, once they lock in those mortgage rates, their mortgage payment will not be rising, but home prices rise, so that's part of their housing wealth. Inventory still remain tight. In fact, for people who are concerned about home price collapse, because people say, well, 15 years ago, home prices increased strongly, then we had a foreclosure crisis. Your response to that is twofold. One, we don't have subprime lending. Second is this chart to show that we don't have oversupply of homes. We are in a very tight market. We need more inventory, and home prices simply do not decline in a tight inventory condition. So we are in much lower inventory condition, and therefore there's, minimal prospect of home prices declining. If there is a price decline, maybe something in Phoenix, San Francisco, definitely not in Mississippi, Alabama, Tennessee, Georgia. I just don't see any price decline in the southern state given relative affordability conditions. And also the builders, they are seeing increased cancellation, but this chart is very interesting. How much extra home in the marketplace for the builders, only the builders, not the multiple listing service. So on the homes that is not yet started, the inventories are beginning to rise. The builders have housing permits and they want to make the transaction immediately, but they cannot make those transactions. Homes under construction, the blue line is rising, but the red line is homes that is fully completed. The garage door came on time, you have the refrigerator. So once home is completed, the inventory level is very low. This is saying that for the home buyers, they want to sign contracts on completed homes and not homes under construction, knowing that there's always supply chain disruptions. So once home is completed, they are able to find buyers quickly. So I would say to the builders, keep building. I know there's some concern about cancel contracts, but once home is completed, they can make those deals, and we need more inventory in the marketplace. Right now, the builders, if you look at the right side represent the single family homes. Builders have been steadily building more homes in the recent years, but this year, forecast in the green line, I think the builders will pull back somewhat this year. So that's gonna hurt some economic activity, fewer construction worker jobs. So the builders will pull back. But the builders are not pulling back on the left-hand side. Multifamily buildings, which is essentially the apartments. There's some condominiums in that part, but it's mostly apartments. So right now, the builders are focused on building more apartments because the rents are rising, but not on the single family little reduction, which also means we will not have any oversupply of homes like in the subprime crisis. Again, we don't have enough inventory. Prices, I am nearly certain that it just simply will not decline in Mississippi, in southern states, even though in some high cost area of San Francisco, they may see some declines. Very depressing figure. Consumer Sentiment Index, University of Michigan survey of consumers across the country about how do you feel about the economy? And they are not feeling good about the economy. Maybe they are reminded when they go to grocery store, all their paycheck is eaten up at the grocery store or at the gas station. And the stock market is somewhat wobbly. So people are not feeling good about the economy, even though we have so many help wanted signs. So this is a consumer psychology. And here's another depressing chart. Question from Fannie Mae survey asking, is it a good time to buy? And people are saying, no, it's not a good time to buy. But I would say that what people say and what people do could be different. Because what you see on this chart is, look at 2020. Is it a good time to buy? And you see no increase in people who say it's a good time to buy. But what did we see in the marketplace? We saw a surge in home sales. So people can say one thing, but people can actually do something else. So it's possible that people are frustrated about mortgage rates, but if the right property comes onto the market and maybe the mortgage rate declines slightly, they will take a chance and they certainly will want to enter the market. And let me put a different survey. This survey is from the New York Federal Reserve. So rather than the question, is it a good time to buy? They pose the question the following way. Is buying a home a good financial investment? And they ask the question, what do you think is going to happen to home prices? People say, well, it's going to rise 5.1%. Then they also ask, what's going to happen to rents? They think rents will rise 6.6%. Because one thing that consumers really detest, even more than higher mortgage rates, is rising rents. People really hate rising rents, and they want to get away from that. And the only way to get away from that is to buy a home. So by posing the question on rents, people are saying, is it a good financial investment? By an overwhelming margin, 73% say yes, is a good financial investment. Only 6% say it's a bad financial investment. So clearly indicating that if you put that rent question to the consumer, people then say it is a good financial investment to buy a home. The question is, let's hope the mortgage rate is not too high so people can afford to buy a home, but we certainly need more inventory. My final slide is this, forecast, what you can anticipate in your business. So 2020 and 2021 has been quite outstanding. On a national level, increased unit sales, increased prices. The price increases in your local area, very similar to what you see on the national. So strong dollar volume growth the past 2 years. But the forecast for 2022, once the December numbers are in, I think the unit sales will be down about 13%. But the prices will be up 11%. So the dollar volume will be down only minimally, maybe about 2%. And let's hope that by 2023, we have continuous job creation and maybe even lower mortgage rates. Maybe the oil prices decline, drill more oil, oil prices decline. So Federal Reserve do not have to raise interest rates so aggressively. And maybe we stop bleeding on the unit sales. On the prices, I'm just being conservative. I think the prices will probably be more like 5%, but based on current dynamics, I've run some economic models, it's implying only 2% price growth, but at least it's not declining anymore like in 2022 in terms of the dollar volume. So thank you for giving me the time to share some of my thoughts with you. And I guess one thing that I did not mention is that the vacation home market was very strong up to last year, which would benefit your local area. You have the water view properties or access to go to the Gulf. But the vacation home market has been very neutral this year. It could be higher mortgage rates, but it could also be that people are not able to get the money out of the stock market because stock market is down. So if the stock market comes back up, maybe the vacation home sale will begin to go back up again. But again, thank you very much for allowing me some time to share my thoughts. So thank you.
All right, thank you,